Earlier today, the board decided to increase the cash rate target by 25 basis points to 35 basis points and to increase the interest rate paid on exchange settlement balances from 0% to 25 basis points. It also decided to not reinvest the proceeds of the government bonds as they mature over coming years. These decisions reflect a judgment by the board that it is now time to begin withdrawing some of the extraordinary monetary policy support that was put in place to help the Australian economy during the pandemic. It now stands at 4%. It's expected to decline over the rest of this year to around 3.5% at the end of the year and into next year. If so, that would be the lowest rate in almost 50 years. It's a remarkable achievement. Labour force participation has also risen to a record high, and a higher share of the working age population has a job today than ever before. The economy is also expected to grow strongly this year, with the Reserve Bank's central forecast being for GDP growth of a little above 4% this year. This resilience of the economy means that the record low interest rates are no longer required. Over the year to the March quarter, CPI inflation was 5.1%, and in underlying terms inflation was 3.7%. These numbers are lower than the inflation rates in most other advanced economies, but they are higher than we have experienced for many years, and they are higher than we were expecting. The main driver of the higher inflation has been global developments, with a series of major global supply shocks pushing prices up over the past year. The pandemic has interrupted supply chains, and it continues to do so with the recent lockdowns in some of the large Chinese cities, again disrupting production and transport. And on top of this, Russia's invasion of Ukraine has resulted in sharp increases in the price of oil and gas, of base metals, and of many agricultural commodities. Inevitably, these shocks to global prices do flow through into higher inflation in Australia.